Hello there. I'm Steve Rick, Chief Economist for CUNA Mutual Group here in Madison, Wisconsin. I also teach economics at the University of Wisconsin in the economics department. I teach the money and banking course and the macroeconomics course to freshmen, which I'm sure a lot of you will be pretty soon in the next couple of years. Anyways, today we're going to look at the top 10 economic indicators every entrepreneur should know. I've been teaching now economics for 21 years, and I've kind of boiled it down to the 21 basically charts and graphs that you should track in order to help your business planning for the next year or two. So let's get started with the first economic indicator, as we call it, and it's basically looking at economic growth. You know, is the economy growing or shrinking? Are businesses and factories producing more goods and services or fewer goods and services? Well, let's take a look at the data. My first chart here talks about U.S. economic growth rate, and you can see there's these green bars and red bars, but look what happened last year in 2020. We had a COVID-19 pandemic that led to a pretty severe recession. If you notice the red bar on the, that was minus 3.5% in 2020, there is your COVID-19 pandemic. We call that a black swan event. Why do we call it black swan? Because it has a low probability of happening, but when it does happen, has a big impact on the economy. So basically, we produced 3.5% more stuff, if you will, goods and services, than we did the prior year. That's a severe recession. A business person should know if we're going into a recession or an expansion. The good news is we've hit a turning point. For this year, 2021, we are forecasting a 4.5% growth in goods and services. So let's take, for example, a company here in Wisconsin. Harley-Davidson Motorcycle out there in Milwaukee, big factory producing motorcycles. Let's just say Harley-Davidson kind of represents the average factory here in the United States in Wisconsin. Well, maybe they saw a 3.5% drop in motorcycle production last year, but this year they expect to do 4.5% more. Once again, I'm just picking on Harley-Davidson as an example. They could be doing more or less. But businesses should know, are we going to an expansion or a contraction phase? Because that'll help in their investment. Should we build a bigger factory? If we think demand is going to be stronger, let's expand operations. So tracking what we call GDP, gross domestic product, which is just the value of everything that we make. We are forecasting for the next 3 years very strong growth. Now you may say, Steve, why do you say strong growth? Well, you see that gold line across my chart? That's right around 2%. Basically, the U.S. economy kind of naturally or organically grows 2% each year. Now, why 2%? Well, basically, our labor force grows about 1% each year. So just think of Harley-Davidson bringing 1% more people into the factory. Also, we produce more output with productivity growth. The average worker is about 1% more productive each year. So economists do the sophisticated math, and we add 1% labor force growth with 1% productivity growth, and we get 2% as our number. That's kind of our benchmark number to compare. And you can see for the next 3 years, we're forecasting stronger growth than that. So if I was a business person, maybe time to expand my operations, invest a little bit more money. Let's move on to my next economic indicator. Probably the second most important one is what we call inflation. Now, what is inflation? That's just when you see a rise in the average price of all the goods and services that you buy. So think about when you go to the grocery store, you're buying eggs and bread and milk. You know, what is the price of that rising? And typically it goes up each year, but the gasoline prices, the rent or the mortgage that you pay, it typically rises all the time. The Federal Reserve, let me bring up the chart, has a target for this, which happens to be the same number we just saw, 2%. The Federal Reserve is our central bank. Basically, when we say the central bank, they control interest rates in the economy, which we'll look at in a minute, but they can raise or lower interest rates depending on the state of the economy. If they think the economy needs to be boosted, like over the last year, they will lower interest rates. So you and me will go out and borrow more money to buy more cars and more motorcycles, say. If the economy is moving too fast, overheating, they say, they'll raise interest rates so people will stop borrowing money from banks and credit unions, and that'll slow the economy down. So 2%, though, is their target. They just believe that 2% is perfect inflation. Not too high, not too low. It's kind of like the Goldilocks level. Well, how has inflation been the last few years? Well, notice my blue line on the chart. It's kind of been below that gold 2% line. So the Federal Reserve has basically been saying the last 10 years, we're not getting inflation high enough. We want prices to be rising a little bit faster. Now, what are the forecasts? Once again, economists get paid to look out into the future. We have our little crystal balls that we look into. We try to predict what's going to be coming in the next couple of years. Notice I have a little green line on my chart. We believe inflation will start to rise later this year. And let me put up what I call the top 6 reasons why we could see higher inflation. These are things that economists track. We track a lot of things. First of all, we believe there's a lot of pent-up demand in the economy. You know, a lot of Americans haven't been going out spending money. They've been sitting at home because of the COVID-19. They haven't been going to restaurants or traveling and buying hotel rooms and airline tickets. But once we reach what's called herd immunity, when most of us are vaccinated and immune from COVID-19, we'll probably see a lot of people go out and spend. And if a lot of people are spending, businesses may raise their prices. Well, guess what? That's inflation. All right, we also see rising energy prices. Your mom and dad, or if you have a car, you're probably seeing gas prices starting to rise, but also other commodity prices like steel, copper, aluminum. You know, that goes into a car, it goes into a motorcycle. So think of Harley Davidson. If they got to pay more for steel, copper, and aluminum to make that motorcycle, they'll try to pass along that price increase with the increase in the price of their motorcycle. Other things that are happening, massive fiscal policy spending. As we know, the government has just signed a $1.9 trillion, let me say that again, $1 trillion spending package. Well, that's going to put a lot of money into the economy. And basically inflation is defined as too many dollars chasing too few goods. If all of us are spending, retailers can raise their prices, and that's how we get inflation. So economists track not only those, but you see I've got 6 factors here. We track a lot of things to try to make our forecast. But in economics, if there are things pushing things up, there are other factors pushing it down. Notice I put up 6 other factors that say no, inflation could actually be lower. Factor number 1, e-commerce. What do I mean by e-commerce? Think of Amazon. I'm sure most of you listening to this have bought something on Amazon. Well, Amazon is one of the most powerful deflationary forces we've ever seen in the history of this country. You know, it's very hard for a local retailer here, say in Wisconsin, to raise their prices when they're competing against online e-commerce type businesses, for example, Amazon. So you can see I've listed 5 other factors here, but economists track all these things, and then we got to decide, are the 6 factors pushing inflation up or the green factors pushing inflation down? Right now, our best guess is we're going to see a little bit higher inflation coming in right at that Fed's 2% target. Let's move on. Let's talk about the labor market. Most of you in a few years will be going to college or getting a job, so you want to understand, how is the labor market doing? Are there jobs out there available? Well, one way economists measure how the labor market is doing is with the unemployment rate. Basically, we look at how many people are unemployed, and we just divide it by all the people who are employed and all the people who are unemployed. So we call it the labor force. How many people are willing and able to work? Well, let's take a look at the latest chart. You can see I've got data going all the way back to 1995 in here. You know, economists, I follow the economist credo that if you can't say it with a chart or a graph, then it's probably not worth saying. So economists love charts. Well, take a look at this chart here. Notice those 2 red bars. Those represent recessions in the past. And you can see whenever we have a recession, the unemployment rate goes up. Now, we're in a recession, businesses lay off workers or put them on furlough. You know, think back in the Great Recession of 2008. You know, you may have Ford Motor Company and General Motors laying people off because people weren't buying cars back then. So the unemployment rate goes way up. Notice what happened last year. We're kind of focusing on recent events. COVID-19 hit us. Notice that spike in that blue line last year. It hit almost 15% unemployment rate. That was incredible. That was the fastest and sharpest increase we've ever seen in the history of this country. The good news is, where are we today? We can see I got my little text box on there. We're at 6.2% unemployment rate today. That's good, but it's not where we should be. Now you say, Steve, where should we be? Well, once again, think of the Goldilocks level. Not too high, not too low unemployment. Basically, as you can see, I put a little box in there saying 4.5% is what economists consider the natural unemployment rate, or kind of the long run average, where the economy tends to go to in the long run. So notice we're at 6.2%. We're slightly high. So most economists say, you know what, we have surplus labor out there. And where is the surplus labor coming from? Well, because of COVID-19, it really hit the service sector of economy, not so much the goods sector. Think of goods like cars, appliances, furniture. Those factories are basically still running. But it's the service sector that really got hurt. Think of restaurants. Your waiter and busboy and your cook. A lot of those have been laid off because, as we know, I'm sure a lot of you haven't been going out eating in 2020. So a lot of those were laid off. Think of hotels. Laid off a lot of maids and workers there. So in the service sector. So economists want to know, well, what demographic group really got hit hard? Well, one, women got hit hard. Women's unemployment rate went up more than men's. Also, minorities who typically work in maybe the service sector, and also low-income workers. People like, once again, a waiter or a maid, typically lower income. So it's those three sectors that economists are focusing on and trying to develop programs to help them get back into the labor market and back into employment. So that's what economists track. And as a business person, you want to know, where is the unemployment rate? Notice before COVID-19, the unemployment rate was extremely low. It was below my goal line. It was at only 3.5%. So if I was a business person a year and a half ago, it was very difficult to find workers for, say, my business. I had to pay higher wages just to attract people. Or I would say stealing them from the business down the street to try to get them to work for me, but I have to maybe give them a little wage premium to attract them to my business. So tracking the unemployment rate can track, hey, is there labor available for my business without having to pay a really high premium to attract those workers. Let's move on. Consumer confidence. This is a big one. Basically, economists survey Americans every month just to say, how do you feel about your personal financial position? Do you feel good about your job, or are you worried about losing your job? Do you feel good about the stock market or bad? How do you feel about your wealth, basically? Well, here's the chart on this. Notice those bars I have on in this chart. Kind of, I guess they look like gold bars. Those represent recessions. Notice whenever we go into recession, consumer confidence plummets. And you can see I got a blue line on this chart. That's one survey we measure, and we basically create from the survey, we create a number or an index. And it tracks through time how people say when the blue line goes up, they're happy and confident about their job and financial security. When the blue line goes down, they're unhappy. Same thing with that kind of yellowish area on the chart. Notice every time we go into recession, consumer confidence falls. And when consumer confidence falls, people stop spending. They don't go out and buy that new car. They don't go out and buy a Harley Davidson motorcycle. They wait till it looks like the economy is getting better. I'm going to go out and spend again. And so right now, as you can see, 2020, that Great Recession, really brought down consumer confidence, and spending slowed down significantly. So if I'm a business person, 2020 was going to be a weak year. Maybe I'm going to have to furlough some workers. Consumers aren't going out and spending. Hopefully, though, once again, with this rolling out of the current vaccine and reaching herd immunity, we do expect consumer confidence to jump back up, and with it, spending to jump back up, which is really going to help the local entrepreneur and business person. Moving on, the exchange rate. Now, let's talk about trading with the rest of the world. As you know, we buy a lot of goods and services from Canada and Mexico. We buy a lot of stuff from China. We bring in BMWs from Germany. We trade with England. So we're trading with the rest of the world, goods and services, which is great. You can buy almost anything you want throughout the world. But what affects the price of what you buy is the exchange rate. How many dollars does it take to buy 1 euro? How many dollars does it take to buy a British pound or Japanese yen? So when you're trading with goods and services, you need to basically have an exchange rate. And here's the chart on this. You see the value of the dollar or exchange rate bounces all over the place. But I want to focus on what's happened recently. Notice recently the blue and the red has declined. All right, if I was a business person looking at this chart and I see, hey, the value of the dollar is falling, would that be good for me or bad for me if I was, say, a Harley Davidson motorcycle? Well, it's actually good, because when the value of the dollar falls, goods made in the United States, like a Ford car or a Harley Davidson motorcycle, is cheaper to, say, somebody up in Canada. So the Canadians buy more of our stuff. But when the value of the dollar is high, like it was just a year ago, it's harder for Americans to sell their goods abroad. So basically, manufacturers like it when the exchange rate's falling. They don't like it when the exchange rate's going up. But in economics, there's always trade-offs. You got to take the good with the bad, and basically the bad is when the value of the dollar falls, let's say you like buying BMWs. Well, when the value of the dollar falls, BMWs become more expensive. You got to pay more for that. Or if you like, if your parents enjoy drinking a bottle of French wine, the bottle of French wine is going to go up in price. Or if you enjoy buying a Sony TV set from Japan, it's going to go up in price. So what helps business people when you have a lower exchange rate hurts consumers as they have to pay more. So tracking the exchange rate is very important, especially if you're a manufacturer or even, say, a farmer here in Wisconsin, or someone who produces cheese here in Wisconsin. It's going to be hard to sell cheese if the value of the currency is high, but when the value is low, like it is right now and falling, it's good. We'll export more cheese and wheat to the rest of the world. Moving on, economic indicator number 6, oil prices. Our economy runs on energy, and we still use a lot of oil today, even though we're trying to transition to more renewable energies like solar and wind, but we still rely a lot on oil. And oil really drives our economy. So let's take a look at oil prices. Notice oil prices go all over the place. Back in 2008, if you look at kind of the middle of my chart there, back in 2008, oil prices hit over $140 a barrel. I mean, you can all picture a barrel of oil, right? It's about this high, about this round, $140 for that barrel. That was one of the contributing factors that led to the Great Recession of 2008, because all of our money, we were spending $4.50 for a gallon of gas. Well, the more money I spend at the gas pump means there's less money available for me to spend at the local restaurant or the local store, buying shoes for my kids, things like that. And it actually helped trigger the recession. But sometimes oil prices fall. Just about a year ago, oil prices were down to about $15 a barrel. So huge fluctuations. So once again, if I'm a big manufacturer like Ford or Chrysler, I need a lot of oil in my production process, and that's going to really impact the price of what I'm selling, the cost to produce my product that I have. And also transportation. Think about moving goods around the country. When you have high oil prices, transportation costs are going to go up as diesel costs and gasoline rises. So tracking oil prices is also a key and very important factor to track. Economic indicator number 7, interest rates. As I mentioned earlier, I teach the money banking class at UW and the macroeconomics class. And the first day of both classes, I asked the students, what is the most important price in any economy? Is it the price of oil, like we just looked at? Is it the price of gold? Is it the price of the dollar, the exchange rate we also just looked at? And I say, no. The most important price is the price of money, interest rates. Interest rates are the most important price that we can track. And let's take a look at what's happened recently. Notice I have 2 lines on this chart. Let's talk about the black line first. That is what we call the Fed funds interest rate. Now, what is that? What's the Fed funds rate? Basically, it's the interest rate that Bank A will lend money to Bank B. So Bank B calls up Bank A and says, hey, can you lend us a little bit of money just for a few days? They go, yeah, this is the interest rate. You can see over time what that interest rate, it can fluctuate. Way back in the year 2000 is around 6%. What is it today? Almost 0. It's basically a 0 interest rate. You can see the black line. It's almost touching the horizontal axis there. It's at 0 today. Notice how kind of smooth that line is. It just kind of moves nice and straight. Now, why does it do that? It's because it's controlled by the Federal Reserve, our central bank. It's controlled by a committee that meets every 6 weeks. They actually just met a few days ago. They basically decided not to do anything with this interest rate, and they're just going to keep it low. Why? They want to stimulate this economy. They want to keep it growing fast after that recession we had last year. So economists are forecasting right now, I'll give you my latest forecast, we don't expect that black line, that Fed funds interest rate, the rate that banks lend money to each other, to go up for maybe 2 or 3 years. The Fed is going to keep it low, and they control that. They can raise it if they want tomorrow, but they're not going to for at least 2 or 3 years. All right, so that's what we call short-term interest rates. Notice there's a red line on my chart. What's the red line? That is the 10-year, now think 10-year Treasury bond. All right. As we know, as I mentioned earlier, we just passed the $1.9 trillion COVID relief plan. We don't have enough tax dollars to spend $1.9 trillion, so we're going to have to borrow that money. So Janet Yellen, who's our new Secretary of the Treasury, she's going to have to issue $1.9 trillion in bonds, basically. And in order to entice people to buy these bonds, she has to pay an interest rate on those. You can see the red line. Where are interest rates today? Well, right now, as I'm making this presentation, they're around 1.5%. So if I buy this bond for 10 years, Janet Yellen and the Treasury will pay me 1.5% interest on that bond. Basically, that's how it works. But notice, it's gone up a lot lately. Basically, it works like this. When the 10-year Treasury goes up, so do the mortgage interest rates in this country. So if you're thinking about buying a house, mortgage interest rates have risen because the 10-year Treasury has gone up. If you're a business wanting to borrow money, the interest rate that you can borrow at as a corporation has also gone up because of this red line. So we kind of refer to the 10-year Treasury as the benchmark interest rate, one of the most important interest rates in the world. That's why if you ever watch CNBC in the morning, that business cable channel, they always have the 10-year Treasury right there on the screen so people can track exactly what it is. Notice it's gone up quite a bit just in the last few months. It was at around 0.7 last summer during the COVID crisis. And now it's jumped to almost 1.5, 1.7. So it's almost basically doubled. And so all the borrowing costs are going up for people who want to buy a house with a mortgage, corporations wanting to borrow. And that, of course, affects your business. If you got to pay more interest to the bank to borrow money to expand your factory, it's going to erode some of your profits. You just won't have as much left over. So tracking the most important price in any economy is very key, and that's interest rates. Let's move on to one of the major sectors of our economy, and I've referred to it a couple of times, car sales. Think of Ford, General Motors, Chrysler, BMW, all these factories here in the United States making cars. We want to track new car sales just to kind of as a good measure of how, if people are spending money and what production is at factories. Well, let's take a look at this chart. First of all, let's take a look at my gold line. That's kind of where we should be. It's a nice benchmark to compare. Notice it's around 16.5 million cars. So auto industry analysts believe, if we sell 16.5 million cars every year, that's pretty good. Notice the blue on this chart is actual car sales of these brand new cars. Notice the last few years, the blue was above the gold, meaning that was a pretty good market. We're selling more than 16.5 million. Notice there's a little V-shaped right at the year 2020, as you would expect. COVID-19, a lot of these auto dealers were shut down by the government because they said, you're not an essential business. We call you non-essential, so we're going to shut you down. Look at that big dip in car sales. It went from about 16.5 million down to 9 million we call it at an annualized pace for a few months there. But notice it's come bouncing right back up to 16.5 million. Remember I said earlier, COVID-19 really hit the service sector, not so much the goods sector. Once again, service would be like restaurants and hotels and airlines, but it didn't really impact General Motors and Ford not much. They have bounced right back here. So this is a good indicator to say, yeah, consumers are still buying cars. The low-income people are still unemployed, but typically low-income people don't buy new cars. They maybe buy used cars. And so we've seen the auto manufacturers are right back to where they should be at around, and you can see the latest number I have up here, about 16.6 million was the recent sales pace in January. That is my latest number on the chart. And I put up here 16.5 million was that long run average, or what economists like to call the inherent demand. Kind of the normal demand for cars is 16.5 million. So the auto sector is doing well. That's great. That's great for our economy and the prognosis going forward. Now, the next one is housing sales. Another big part of our economy is building homes. Here throughout Wisconsin, you see home builders, buying up some farmland, digging a hole, pouring concrete, building a nice new house. Well, let's talk about these housing sales, very important part of our economy. Take a look at this chart. Here's my green chart, is basically the number of homes that we sell every year in this country. The latest number is around 6.8 million. Notice that green has kind of spiked recently. And you may ask yourself, well, why are we selling so many homes right now when we're kind of still in this COVID-19 crisis? Well, once again, it has to do with the most important price in the economy, interest rates. Basically, interest rates hit their low point, as we saw last summer when that 10-year Treasury, that red line on the previous chart, hit its bottom. Well, 30-year mortgage rates also recently hit bottom. So a lot of people ages between 25 and 39, that's kind of the age where you may be getting married, having kids, and then you buy a house. Well, we call those people between 25 and 39 the millennial generation. There's a lot of millennials out there. There's 83 million millennials out there. That's the biggest demographic group we have. And they're buying a lot of homes, and they're buying them because interest rates are so low. Because typically, if you buy the average house today, it costs $300,000. Most people don't have $300,000 saved up, so they got to borrow the money from the bank. So basically, when you're buying a house, you're also buying money. And remember, interest rates are the price of that money. And with interest rates being low, everybody wants to buy a house today. And so home sales are skyrocketing, but also you have demographics. So economists have to track this thing called demographics. How many people are in that age range between 25 and 39, which is those prime home buying years. What's interesting, what's kind of considered a good housing market? Notice I've got that gold line right across my chart. Once again, we want this benchmark. 5.5 million is what we consider good. So if we're at 6.8 million, that's like really good. And that's really driving this economic recovery today. One more item on this chart is that blue line. The blue line is the number of homes for sale in this country. We call it the inventory. You can think about it. How many homes have a for sale sign, jammed in the front yard grass right there? There's only about 1 million homes throughout the entire United States that have a for sale sign in the front yard. Where was it just say 12 years ago? About 4 million homes were for sale. We only got 1 million today. Basically, in economics, if you have a limited supply, like of homes for sale, but you have a strong demand because you have all these millennials out there, what's going to happen? Well, home prices. Notice I just put on the screen. Home prices last year in 2020 rose 13%. That is incredible, a 13% increase. I don't know about you, but not too many people got a raise at their job of 13%. So home prices are rising at some of the fastest pace we've ever seen in this country. So I want, as my last kind of economic indicator here, is look at home prices. Because most of you at some point in your life will own a home, and you'll want to track, is your home price rising or falling? Well, let's take a look at home prices as our last economic indicator. Here it is. This is looking at the price of what we call the median. Think of the average price, the median price of existing homes. And so when we sell these homes, the government tracks or institutions track, what's the average price of homes being sold? Notice I got data all the way back to 1975. Notice mostly home prices increase, which is great, right? If I buy a home, I want to see it go up 5, 6, 7, 8% each year. I don't want to see the price fall because your home is an asset and you want your assets to go up in value. Notice, however, there was a few years there after that great recession back in 08, 09, 010, where home prices actually fell. But that is a rare event. You got to go all the way back to the 1930s, the Great Depression, to actually see home prices fall. I remember my father telling me when I was getting right out of high school, going to college, he told me, Steve, buy a house. They're a great investment. Well, he told me that back in the early 1980s, before the 2007, 2008 crisis. So he was right back then. Home prices always did go up, but sometimes they do fall. Now, notice in the subtitle on this chart, I have the word nominal annual home price increase. Now, economists hate that word nominal. We want to adjust for inflation. So we want to calculate what's called the real price appreciation. So notice, let me pick on the year 2005. I'll pick on the year because that was one of the years we also saw 13% increase in prices, just like we did last year. But back in 2005, prices of the goods and services that you and I buy just to live, or what we call the cost of living, went up 3.5%. So think of the price of milk going up 3.5% and bread going up 3.5%, gasoline. On average, prices just rose 3.5%. So what economists do is very simple. We take that 13% increase in home prices and we just subtract out the 3.5% inflation of goods and services. And it calculates, do the simple math, it comes out to a 9.5% real appreciation in the value of my home. All right, that's pretty good. I would love to see my house going up 9.5% each year in real terms. So whenever I subtract out inflation, I go from nominal to real. Very simple. Well, let's do the following. Let's subtract out inflation for each year on this chart. So what was the inflation rate back in, say, 1975? Subtract that away from the price increase in homes. If we do that, what actually happens to my chart? Notice, kind of focus your eye on this green chart. I'm going to subtract out inflation. What's going to happen to it? It's going to look like this. Notice the bars are sometimes positive, but now sometimes negative in real terms. That's why economists hate nominal. We like to look at real. Now, you probably heard this expression, the business cycle. Sometimes the economy is expanding, sometimes it's in recession. Sometimes it's expanding and recession. Well, notice in the housing market, we see it clearly laid out in home prices. Let's go back in time. Let's go back to the 1970s. Jimmy Carter's president. Notice we had 4 years, I have a little circle there with my pink circle, 4 years where home prices were rising faster than inflation, so the real appreciation was positive. All right, that's all we're doing. That's a good year to buy, that's a good time to buy a home. All right, that's a great investment. But notice it was followed by 4 years of down cycle. Notice 4 years, those negative numbers. So maybe home prices were rising, but inflation was rising faster than that. Housing is not a good investment. Notice we got a little cycle here. Let's go forward in time a little bit more. In the middle 80s, Ronald Reagan was president. 5 years of these bars being positive. Once again, the value of my house was rising faster than the price of milk and bread and inflation. 5 years of an upcycle, followed by roughly 5 years of a down cycle. Notice a lot of those bars were negative here. Once again, it's just saying inflation now was rising faster than the price of my house. That's really not a good time to be buying houses back then. Your home value is declining. But then notice in the kind of the late 1990s, the early aught years as we call them, we had 9 years of an upcycle. It kind of broke the trend. For a while there we had 4 years up, 4 years down, 5 years up, 5 years down. But now we went to 9 years. We kind of doubled the length of time of home prices rising. We actually call that the housing bubble. The Federal Reserve pushed interest rates really low for a long time. A lot of people bought homes and home prices kept rising. Now I want you to play the economist. I want you to forecast. We had 4 years up followed by 4 years down, the pink. 5 years up followed by 5 years down, the brown. Now we had 9 years up. What do you expect for the future then? Would it be 9 years down? Well, no, it wasn't 9 years. It was only 6 years. But for some of those years were big drops, about 14%. So notice the business cycle playing out here. Now, where are we today? That's the past. It's great to learn from the past because they say, the past is prologue. Or Mark Twain once said, history doesn't repeat itself, but it does rhyme. We kind of see similar patterns over time. What do we have recently? 9 years of an upcycle. 9 years where home prices are growing faster than inflation. Economists are looking at this saying, oh, could we see 9 years of a down cycle coming soon? Or something like that. Maybe not 9, maybe 6, 7, 8. Our best guess right now, we're not going to see the down cycle yet. We still have a lot of millennials out there buying homes. We have a shortage of homes, as we saw earlier. Only 1 million homes are available for sale today that have a for sale sign in them. So we don't expect it to happen in the next maybe 2 or 3 years. But after that, expect a correction, like we always do. So anyways, I hope this has been helpful, just looking at the top 10 economic indicators every entrepreneur should know, but really every American should know. Thank you for your time.